Hi, I'm Jessica Amir for the Finance News Network. Joining me from the Ausbil MicroCap Fund is Portfolio Manager Mason Willoughby-Thomas and Equities Analyst Arden Jennings. Welcome.
Thank you. Thanks for having us.
First up, can you give us an introduction to the fund and its performance?
The Ausbil MicroCap Fund is a fund that focuses on companies that sit outside the ASX 200. Its investment target is to exceed the benchmark by 5% per annum on a rolling 3-year basis. Returns for the most recent quarter, the September quarter, were quite good. The fund delivered a net return of 11.2% after fees, which exceeded the benchmark by 2.3%. In terms of the positioning in the portfolio, so the key changes we've made since reporting season have been to reduce our weighting to the consumer discretionary space, where we're seeing a combination of both cyclical and structural pressures. At the same time, we've upweighted our exposure to the materials and mining services sectors.
And just on the mining services sectors, part of that move was at the beginning of the financial year, we had cautious optimism that the mining contractors and infrastructure space was gathering steam. And following 2 recent trips to Perth, that confirmed our conviction that order books and pipelines were strong.
From a bottom-up perspective, the mining services contractors are particularly well placed to benefit from the uptick in investment in the mining and infrastructure space. Their business models are leveraged to activity levels in these different sectors. As well as that, they have been raising capital and using growing levels of internally generated cash flow to pay down debt and deleverage their balance sheets. In response, we've invested in a number of the names, in particular Emeco, an equipment hire company, as well as NWH, which is a mining services contractor with exposure to both mining and infrastructure on the east coast of Australia.
A more general question now. Can you tell us about the performance of small caps?
Following a subdued period of performance by small caps, in the last 3 months, we've seen small caps outperform large caps. And this has primarily been driven by the small resources outperforming industrials.
Small caps are particularly well placed to benefit from improving global growth, given they offer more leverage due to relatively immature business models and superior growth profiles.
So back to the fund, guys. Can you tell us about your largest positions and if you've made any changes?
Yeah, one of the more exciting parts of the portfolio has been the electric vehicle thematic. We've been investing in a number of ways to get exposure to this new and exciting thematic. We've been building our exposure to lithium. Lithium is a key component in the development of batteries for electric vehicles, as well as Lynas, which is a large producer of rare earths minerals, which go into the production of motors for electric vehicles. We've also been building our exposure to other important commodities such as nickel and copper.
Another long-standing position in the portfolio in the industrial space is Smart Group. This is a salary packaging and novated lease provider. It's an industry leader providing services to governments, institutions and also charities. We like the business because it's capital light, it is highly cash flow generative and the balance sheet is in good shape. The stock is appropriately priced, it's on 11 times EBITDA with roughly 15% EPS growth, so we find it hard to fault.
Look, we're cautiously optimistic that the current conditions can continue. Our top-down work internally suggests that strong global growth is set to continue, and we believe that small cap companies are particularly well placed to benefit from that. Mining services, as we've discussed, have good pipelines and order books, giving them visibility over the next 3 to 5 years, which we expect will continue to be a strong thematic. Synchronised growth globally should be supportive for metals prices and therefore supportive of resources. We continue to be cautious on the consumer, on the domestic consumer and domestic cyclicals generally, given where the Australian economy is at the moment. We have a focus on high quality industrials, which have strong sustainable business models. We also remain cautious on the outlook for so-called bond proxies, and which are particularly sensitive to moves in interest rates as bond yields in the US start to rise. These sectors include real estate investment trusts and utilities and large telecommunications companies.
Mason Willoughby-Thomas, Arden Jennings, thank you so much for the update.
Welcome,
Thank you.
Thank you.